Every year, the IRS changes contribution limits, and these changes don't always have a rhyme or reason. So let's take a look at what's actually changing for 2026 and the details most people overlook when they skim the updates. In aviation, a waypoint is where you adjust course to stay on track. In financial planning, we call those critical financial events. I created this channel so that no matter what life throws at you, you can maintain the vision to see beyond the waypoint. Let's start with common employer plans. The big ones, 401k, 403b, 457, and TSP limits. Employee contribution limits for 2026, the IRS raised it to $24,500. This is your salary deferral. Employer money does not count towards this limit. Total contribution limits for 2026, which include your contributions, employer match, employer profit sharing, and after-tax contributions, if your plan allows, is $72,000. This is the number that matters if you're working toward the full plan max or using after-tax contribution for make a backdoor Roth, assuming, again, your employer allows it. If your plan does not allow for after-tax contributions, you will have a hard time hitting this limit. Next, catch-up contributions. These kick in at age 50 and older. The standard catch-up for 2026 is $8,000. So if you're 50 or older, your personal max becomes $32,500, $24,500 regular deferral plus $8,000 for your catch-up. You now also have an enhanced catch-up for those who are 60 to 63. Secured 2.0 says it should be greater of $10,000 or 150% of the regular catch-up. 150% of $8,000 would be $12,000, but as of now, the IRS says the enhanced catch-up for 2026 is $11,250, the same as 2025. No idea why they didn't follow the full 150% math, but the IRS announcement is what we go with. So if you're 60 through 63, your employee max in 2026 is $24,500 plus $11,250, which equals $35,750. An important note, the enhanced catch-up replaces the normal catch-up. You don't get both. If your 2025 wages from the employer sponsoring the plan are above $150,000, then all catch-up contributions in 2026 must be Roth. If you're under that amount, you can still choose pre-tax or Roth. This was part of the changes made in the Secure 2.0 Act. IRA and Roth IRA limits for 2026 are $7,500. You also get an $1,100 catch-up if you are 50 or older. The income limits you have to stay under to contribute directly to a Roth IRA in 2026 are $168,000 for single filers and $252,000 for married filing joint. Above these ranges, you will have to utilize the backdoor Roth strategy. HSA limits also changed for 2026. For individual plans, it's $4,400. For family, it's $8,750. There's also a catch-up of $1,000 if you're over 55. A few important nuances. First, family coverage is no longer double the single limit like it was in 2024. The IRS broke that ratio in 2025 and decided to keep it broken in 2026. So yes, it makes remembering these numbers harder. Second, the HSA catch-up doesn't start until age 55, not 50. And unlike the IRA catch-up, which now adjusts for inflation, the HSA catch-up is not inflation adjusted at all. Why they didn't fix both while writing Secure 2.0, no idea. Minimum deductibles for plans to be considered high deductible health plans in 2026 are $1,700 deductibles for individual plans and $3,400 deductible for family plans. If your plan doesn't meet those minimums, no HSA contributions. And remember, employer HSA contributions do count toward your limit. If they put in $1,000, your personal max drops by $1,000. There are a lot of moving parts here, and the IRS updates these numbers every single year. The key is not memorizing them, but understanding how they apply to your situation, your income, your employer plan, and your overall strategy. Getting these limits right can make a real difference in long-term tax efficiency and financial independence. Not all flights will be without turbulence, so it's important to make adjustments when needed. Like and subscribe for more videos on how we support clients in their financial journey, helping them see beyond the waypoint.